Hello, aspirants. Considering your preparation strategy, here I am with the most important topics of the subject accounting for BCom Honors CUT. We have been covering the topics. First is analysis of financial statement. Second is accounting not-for-profit organization. Under analysis for financial statement, we'll be covering the accounting ratios. We are saying accounting ratios, ratio analysis, or financial ratio analysis. It's just the same. We will doing based on the historical data, change in accounting policies, absence of identical situations, and qualitative factors are ignored in this process. The content of accounting ratios cover liquidity ratios, leverage ratios, activity ratios, and profitability ratios. There are 4 kinds of ratio and further bifurcated. First is liquidity ratio, where there are 2 types. First is current ratio and asset ratio or quick ratio. Second is leverage ratio. It is further bifurcated into 3 parts. First is debt to equity, total assets to debt, and interest coverage ratio. Next is activity ratio. Under activity ratio, we have 3 partitions. First is inventory turnover ratio, debtor turnover ratio, and working capital turnover ratio. At last, but not least, it is profitability ratio, which covers the 4 part. First is gross profit ratio, net profit ratio, operating expense ratio, and return on investment. First, we'll be starting with liquidity ratio. It has 2 components. First is current ratio and quick ratio. And the current ratio, as the name suggests, it defines the relationship between current assets and current liability. It is also known as working capital ratio. This ratio is calculated by dividing current assets upon current liabilities. To do such bifurcation and such division, we should knowing that what is current assets and current liabilities. Current assets are cash in hands, cash at bank, marketable security short term, or we can say treasury bills are also included in current assets, short term investment, sundry debtors, bills, receivables. Inventory include your raw material, work in progress, finished goods. Prepaid expenses are also included in current assets, advance tax paid, and accrued income. Let's talk about current liabilities. It will cover all the liability portions which are less than 1 year. First is sundry debtors, bills payable, bank overdraft or cash credit, short-term advances, outstanding advances, income tax payable, and dividend payable. Now, the interpretation of the ratio is very important. As a conventional rule says, current ratio is of 2:1, means 2 is for current assets and 1 is for current liability, as it is considered satisfactory. The logic says, even if the value of current assets become half, the firm will be able to meet its obligation fully. The 2:1 ratio is referred to as rule of thumb or arbitrary stance of the liquidity of the firm. This ratio represents the margin of safety for the creditors. The realization of assets may decline. However, all the liabilities have to be paid in full. At last, current ratio is a test of quantity, not the test of quality. As we have already mentioned, it is a non-qualitative analysis. It is essential to verify the composition and quality of assets before finally taking a decision before the adequacy of the ratio. Next portion was quick asset ratio, liquid ratio, or asset test ratio. Liquid ratio goes like this. It will cover 2 portions, liquid assets and liquid liability. Liquid assets is current assets minus stock, and liquid liabilities, or we can say quick liabilities, are current liabilities minus bank overdraft. The formula says current assets upon current liabilities. Next, we'll be covering leverage ratio. Under leverage ratio, we have 3 portions. First is debt equity ratio, total debt, interest coverage ratio. Moving on to first part. First is debt and equity ratio. For knowing everything, we should know what is debt and equity. Debt include only long-term debts, means long-term liability, and equity is the shareholders' capital, which is equity share plus preference shares or reserves and surpluses. So, debt equity ratio is also known as external internal equity ratio. This ratio is calculated to measure the relative claims of outsiders and owners against the firm's asset. This ratio shows the relationship between external equities, that is, outsiders' fund, and internal equities, that is, shareholders' fund. We'll further bifurcate or differentiate our formula in total debt upon net worth, or you can say equity. Net worth include equity share capital plus preference share capital plus reserve and surplus. Or we can say our formula with the long-term debt upon net worth or long-term debt on net equity. The interpretation of every ratio is very important because the question will form from such interpretations. Next, this ratio says the extent to which debt financing has been used in business. Now, ideal rule of thumb or thumb rule for this ratio is 1:1. This shows the level of dependency on the others. But general rule also says that there should be a mix of debt and equity. The owner wants to conduct business with maximum outsiders fund to take less risk for the investment. At the same time, they want to maximize their earning at a cost and risk of outsiders fund. Next portion is total debt ratio. Under total debt, we will be covering long-term debts plus current liability. It compares the total debt, which is inclusive of long-term as well as short-term, with the total assets. The interpretation of this ratio says that it depicts the portion of total assets financed by total liabilities. Higher the debt equity ratio or total debt ratio shows that firm is trading on equity. In case the return of firm or rate of firm is more than the cost of debt, it implies high return to the shareholders. On the other hand, if a lower ratio implies lower risk to the lenders and creditors of the firm and non-existence of trading on equity. Important points. Higher the ratio is a threat to the solvency of the firm. Threat to the solvency means firm will no longer be able to continue their business if this ratio is higher. Lower the ratio means indicate that the firm may be missing the available opportunity to improve the profitability. Because for getting the opportunity, we have to take risk. Whenever we are taking the risk, we are taking the liabilities also. And we are adding liabilities, there is higher ratio. But the proportion should be balanced. So the balanced proportion of debt and equity is required so as to take care of the interest of lenders and the shareholders and the firm as a whole. Third portion was interest coverage ratio. Debt ratio are static and fail to indicate the ability of the firm to meet the interest obligation. That's why we have introduced a new ratio, which is interest coverage ratio, to test the firm's debt servicing capacity. The interest coverage ratio shows the number of times the interest charges are covered by the funds that are ordinarily available to pay interest charges. Here, the formula is like this, EBDIT. It means earning before depreciation, interest, and tax, divided by interest on the current liabilities or the total liabilities. The interpretation of this ratio is it indicates the extent to which the earnings can fail or fall without causing any embarrassment to the firm regarding the payment of interest charges. Higher the interest coverage ratio, better it is for both the firm and the lender. For the firm, the probability of default in payment is reduced, and the lender, the firm, is considered to be less risky. Too high a ratio, the ratio is very high, it indicates the firm is very conservative in not using the debt to its best advantage of the shareholders. Limitation is this ratio is based on actual concept of accounting, means the interest is to be paid in cash. Therefore, it is better to compare the interest liabilities with the cash profits based on cash inflows and outflows, both for incomes and expense of the firm. This ratio again ignores the repayment of installment liability of the firm. We should consider such points in the answer writing and also attempting the MCQ parts. Next, third portion was activity ratio. It is again bifurcated into inventory turnover ratio or inventory velocity. Second is debtor turnover ratio or debtor velocity ratio. Third is working capital turnover ratio. First is inventory turnover ratio. Though the term turnover means getting out. Whenever the stock is getting out of the warehouse of the factory, it is termed as turnover. So this ratio says like this: how much inventory has been transferring, has been out for the sale. It is calculated by dividing cost of goods by the average inventory. The formula is cost of goods sold divided by average inventory at cost. The formula for average inventory is opening stock plus closing stock divided by 2, just like average we do in our maths. Cost of goods sold, the formula is the opening stock which we are having in our warehouses plus purchases minus closing stock, or we can say net sales minus gross profit. So another formula, whenever with what kind of information you'll be getting with to solve the questions. The interpretation of this formula is inventory turnover ratio shows the velocity of stock. Higher the ratio indicate the firm is moving the stock better for the profitability. In such a situation, it would be more. A very high ratio shows that a firm has been maintaining only fast moving stock. It is not considering the slow moving stock. A firm may not be maintaining the total range of inventory and so may be missing the business opportunity which may otherwise be available. It is better to compare the turnover ratio with the industry or its immediate competitors. Another interpretation is if the ratio is too high, it is indicated that it will blocking the unnecessary fund. It can be utilized somewhere else. Second point, unnecessary payments for extra go down space for piled up stock. Third is chance of obsolescence and pilferage or more. Fourth is likely deterioration in quality. And above all, slow movement of stock means slow recovery of cash. Second part is debtor turnover ratio or debtor velocity ratio. First of all, we need to understand what is debtor. Debtor is the customer who will be giving us the money or the cash for their services. First, firms sell goods on cash or credit. As and when goods are sold on credit, debtors form, and these may be known as receivables appear in account. Debtors are expected to be converted into cash over a short period of time, and they can be included into or are included into current assets. Debtor turnover ratio. Debtor turnover is found out by dividing current credit sale by the average debtors. Whenever we are doing credit sale, debtors are formed or bills receivables are formed. So formula is credit sales divided by average debtor. Debtor turnover ratio indicates the number of times the debtors are turned over each year, means how many times debtor or the customers are paying up money for the credit sale. Higher the debtor turnover ratio, more efficient is the management of credit. If the bill receivable is outstanding, they are to be added to the debtors as bill receivables. have come into balance sheet in place of debtors which are still outstanding. Next is debtor collection period. Debtor collection period is termed in terms of days, weeks, or year. If we want our debtor collection period in terms of days, we will be doing formulas like this: 360 divided by debtor turnover ratio. This ratio indicates the speed of their collection. Shorter the period, better is the quality of debtors. A short collection period indicates the efficiency of credit management. The average collection period should be compared with the credit time and policy of firm to judge the quality of collection efficiency. Third portion is working capital turnover ratio. Now, working capital indicates the velocity of utilization of working capital of the firm. Now, for this, we should know what is working capital. It is current assets minus current liabilities. Refers to as net working capital, which is equal to current assets minus current liabilities. Now, ratio for working capital turnover ratio is cost of sales or sales upon average working capital. This ratio indicates or measures the efficiency of working capital management. A higher ratio indicates efficient utilization of working capital, and a low ratio indicates otherwise. High working capital indicates lower investment in working capital, has generated more volume of sales. But it also indicates improved profitability of the firm. But a very high is also not desirable, as it also says like over trading, means there may be inadequate of working capital to support the increased volume of sales. So this may be a risky portion to the firm. Fourth portion is profitability ratio. It has four components. First is gross profit ratio. Second is net profit ratio. Third is operating expense ratio. And fourth is return on investment. Profit is a factor of sale. Profit is earned after meeting all expenses as and when sales are made. Gross profit ratio reflects the efficiency with which a firm produces, sell its different products. So gross profit is sale minus cost of goods sold. For getting the gross profit ratio, the formula goes like this: sales minus cost of goods sold divided by sale into 100. Gross profit upon sale into 100. The interpretation of this formula is it indicates the spread between the cost of goods sold and revenue. Analysis gives the clue to the management how to improve depressed profit margin. From this, we'll get the clue how we can manage our profit margins or sales margin. The ratio indicates the extent to which the selling price can decline without resulting in losses on operation of the firm. Higher the gross profit ultimately will give a good sign to the management and will increase the profitability and also the profit margin. Second is net profit ratio. Net profit is obtained after deducting the operating expenses, interest, and taxes from the gross profit. Here, the net profit includes non-operating incomes, so the latter may be deducted to arrive at the profitability arising from operation. Net profitability ratio says the formula is we want profit after tax upon sale into 100. We do after tax, not before tax. The interpretation of this ratio says that it indicates the overall efficiency of the management in manufacturing, administrating, and selling the products. This ratio has a direct relationship between the return on investment. If net profit is higher with no change in investment, then return is also high. If there is fall in profit, return on investment will also go down. Means there is a direct relationship between return on investment and net profit. Third interpretation was operating expense ratio to identify the cause of fall or rise in net profit. Each operating expense ratio is to be calculated. Now, the formula says operating expenses divided by sale into 100. Interpretation. The behavior of specific expenditure is to be seen in comparison to the earlier years in the same firm. This throws the light on the managerial policies and action. Operating expenses example is advertisement expenditure, may be going on for year to year with no significant increase in sales. But it may be due to inefficiencies promotion is not bringing down the increased sales despite more expenditure on advertisement. Fourth is return on investment. Return on investment is a primary ratio that is most popularly used to measure the overall profitability and efficiency of business. When return on investment is calculated on total assets, it is known as return on total assets. Total assets are related to the operating profits. Operating profit is earning before interest and tax. It is also known as EBIT or EBIT in absence of other income. EBIT is arrived at by adding interest and tax to net operating profit. The formula is, we can say return on investment or return on total asset. The formula is earning before interest and tax upon total assets. Next, we will be covering the topic which is accounting not-for-profit organization. The contents which we'll be covering are meaning of not-for-profit organization, its example, receipts and payment, meaning and concept, preparation of income and expenditure statements. Accounting for not-for-profit organization, it includes basically this organization do not run on the motive to earn profit. The purpose is to promote cultural, educational, health, and religious activity. They mostly run on charitable purposes, for example, school, college, public hospitals. Accounting not-for-profit organization. It has two components. First is receipts and payments. Receipts are usually on the left-hand sides and payments are on right-hand side. Receipts include cash in hand, cash at bank. The total receipts are for the previous year added for the present year or for the next year. To grants for the specific purpose, to general grants, general donations, rents received, to dividends, interest received, or we can say life membership fees, all the subscription fees, sale of fixed assets, or bank overdraft sometimes. Characteristics of payment. Payments include salaries, which will be going, rents, repairs, investment, audit fees, miscellaneous payment, insurance, drawings, our bank overdraft, buildings, books, and loans. Or we can add our closing balance in the form of cash in hand or cash at bank. The format for income and expenditure account is expenditure, where we have printing and stationery part, lighting, rates and taxes, telephonic charges, postage and courier charge, wages and salaries, insurance premium, depreciation, repairs, sport material used, audit fees, and the surplus, which is excess from income over expenditure. Income. Income is the subscription which this not-for-profit organization is getting, the entrance fees or admission fees, or we can say interest on investment, lockers rent, general donation, sale of old newspaper, rent received, legacy, which is general amount, gains or profit on sale of fixed assets, sundry receipts, and deficit, which is a loss or which is excess of expenditure over income. Here, we'll be covering some MCQ part from the not-for-profit organization. I'll be discussing the questions from ratios in the next video. So here, the question is, Which of the following is incorrect? Here, the first part says receipt and payment is a summary of cash and bank transaction. No. Yes. Second is receipt and payment account does not show that any cash, non-cash items like depreciation. True. Capital fund is calculated as asset and liabilities. True. But sale of scrap is a capital expenditure and to be recorded in income? No, this is not a capital expenditure. This is extra expenditure which is not to be included in income and expenditure. Subscription. Second question is subscription received from members is to be accounted on. First point, asset side of balance sheet. Second is credit side of income and expenditure account. Subscription received is a income, which is on the right hand side of the format of a table, which is income and expenditure statement. Hence, the credit side is the correct option for the subscription received from the members. Income and expenditure account reveals surplus and deficit, not profit, not gross profit, not cash in hand or cash in bank. Income and expenditure always survive on, always reveals the surplus and deficit. Fourth part is subscription paid by members is receipt in the receipt and payment account because it is the main purpose income for the not-for-profit organization. And as income in the income and expenditure, it will become income and receipt as accordingly with the statements. Fifth part is the fund received or raised by not-for-profit organization are dashed to the capital fund or general fund. They are credited to the general fund or the capital funds because they are the main income source. Thank you all. If you have any query, we'll be sharing such queries or such portion in the next videos. Thank you.